Good morning, Monday, March 9th, 2026. And here is your market update, Clubhouse Insider, and weekly reminder to stop trying to time the markets. So let's dive in. First and foremost, we have officially hit daylight savings time. So hopefully you're not feeling too off this morning and you've remembered to reset your clocks and haven't been late to anything. So first off, with the information here, we want to highlight over the past couple weeks what we've been seeing. So buyer activity, if you're looking to purchase a home, buyer activity has been picking up quite a bit. We're starting to really see something we haven't seen a lot lately, which is competition, buyers competing with other buyers again, multiple offers. Even if it's only a couple, it's still multiple offers. Sellers are gaining a little bit more leverage than what they had previously. So it's starting to pop up again, especially in certain price ranges when the homes are listed and priced very well or correctly, which is telling us that demand is still very strong and very much out there. Everybody's been hearing about that term pent-up demand, which is still, very, very strong. So mortgage rates, however, are starting to retreat in the wrong direction once again. So a big reason is geopolitical risk. You probably started to hear things like the Strait of Hormuz. What is that? Why does it affect my mortgage rate for buying a house here? What's crazy? Well, oil supply is tied to the conflicts that we're seeing overseas in the Middle East with Iran. And when markets start worrying about global energy supply and inflation risks, which is what's going on with the oil, they're worried about that causing inflation here at home, bond markets react very quickly. That pushes mortgage rates higher. And this is a perfect reminder. We like to talk about it a lot. When markets dip, you have to be ready to act. We've seen opportunity lately. We've had 3-4 year lows. But again, what you see on the news, it hits a little bit late. So when you work with somebody like me, we can lock rates, we can get it going before the news knows about it, before those reports come out a month later and the markets have already changed. So there's opportunity. We've seen pullback, but if you wait for the absolute perfect moment, you're going to end up waiting a lot longer while the market starts moving the other way again, which is happening right now. So real estate is a long-term strategy, not a perfect timing game. So I'm going to go on a bit of a rant and share some other trends as well that I've been seeing, but let's take a look at the markets. So I've had this up here. Hopefully you've had the opportunity to kind of review this. These are inflation concerns. This causes rates to go higher. Oil prices, look at this just over the last month, right? This is what they're talking about because of the situation over in Iran. Now, we see rates. Last week, we were at 5.99. Well, here we are, 15 basis points to the actual rate, but really we've seen more than that to cost. So the cost to get a 5.99 now is a lot more expensive than it was last week if you're looking to buy down rates, for example. So what I want to go on a rant about here a little bit is debt and being ready. What does that mean to be ready to pull the trigger when rates come back down? Again, it's a long-term here. So what we're noticing, because more buyers are out there, we're getting more applications, we're seeing more things. Obviously, hopefully everybody hears the stats about credit card debt. There's trillions of it with American consumers. It's more and more. So there's debts, there's late payments. I'm even seeing credit scores come in lower than what people anticipate. So if we're seeing credit card rates around 20% or higher, balances are climbing, why aren't people waiting on credit card rates to come down to apply for another credit card? Well, we have some spending problems in America. Lots of people like to spend money, whether they've got it or not. So if you want to buy a home, we have to make sure to keep things in perspective for the long-term financial health of yourself, your family, right? We were looking to build wealth long-term. So you've got to understand your full application, what all the debts are that are going out every month, all of your income coming in. As mortgage, underwriters, that's what they're doing. That's what they're calculating. They're saying, are you a risky applicant or not? And so when you show that your credit card debts are going up, that's going to affect how much you can get approved for. So ask yourself some questions. If houses are important to you, if refinancing is important to you, making sure you can qualify again. Just because you have a home doesn't mean you're automatically going to qualify for a refinance if you've got some additional debt that you did not have at the time of purchase. So, spending, shopping, restaurants, are those things important? Or are we trying to save, plan to be set up later, right? Because homes and everything else can really help you in times of, for example, retirement. So if someone is sitting on the sidelines right now waiting for mortgage rates to drop just a tiny bit more, not quite enough savings, if you're going to wait, which, it's hard to time the market, very, very hard. So right now people are doing that. All of a sudden we're going backwards. Now you've got even longer that you're going to have to wait to be able to take advantage of those savings that the market handed you. But if you're going to do it, in the meantime, let's talk about where our credit card debt is. Do we need to pay it down? Do you even know what your credit score is? What can you do to improve it? Do you have any other kind of personal debt? Can we get that lower? Can we make things better on your balance sheet as it stands? I would just hate to wait for people to, just keep on waiting and waiting for those small improvements in mortgage rates while they're paying over 20% in credit cards. So you can see here, average FICO score in America around 715. You're not going to get the best interest rate at even 715. So if you've got a credit score in the sixes, you got to try to see everything you can do to get over 7, and then over 740, etc. Those are what the goals should be that you're targeting. Average, we have a record high of $1.28 trillion in credit card debt. And again, here's another example of how the data delays. This is as of Q4 December, right? We're almost done with Q1 2026, but we don't have the data out yet. That's how the market works. Everything works, behind. So here's some more information that's just kind of interesting to see. Credit cards are over 20% on average. This is what we consider, right? Excellent credit is 740 or higher. Good, I would probably say, is really 700 or better for mortgages. That's where you're going to see better rates and better mortgage insurance, right? Monthly PMI, you're going to get better if you have a higher score as well. That's where people can really have their monthly payment hurts, is if your score's in the sixes, you're not going to get very good PMI, for example. So, and then here's, of course, the chart. Boom, straight back up, right? This is not what we want to see. We want to see that trend down and to the right. But things are going to always upset the markets. There's always something going on. So trying to time the market is incredibly difficult. Your house is a tool. What if we can take savings by paying off some of this debt from some equity that you might have, even though it's not the lowest rate that you're looking for, but we can use a total picture of all of your debts. We analyze the entire thing and make sure that the money going out is a lot less than it currently is. That's the kind of opportunity that we need to be keeping an eye on too, if you own a home. And of course, if you're trying to buy a home, that's exactly why. You want to get that started now and not wait, because real estate is a long game. So the longer you wait, the longer you'll wait to get the results on the back end as well. So build the right team around you. Work with real advisors, not just sales gimmicks. The gimmicks are for commissions for the salespeople. Okay, those aren't for you. They can be okay sometimes. We just got to really make sure you understand the offer, the loan estimates. So if you have any questions about things like that, we're happy to analyze those for you. Make sure you're getting a good deal. Maybe we can beat it, maybe we can't, but we're happy to do that because we don't want people falling into any sales gimmicky traps. Okay, stick to the fundamentals. Work on being as good as you can as an applicant on paper. These markets are always going to be volatile. They want to guess. That's what markets do. So buy the dips when the opportunities are presented. Stay disciplined. If you have any questions at all, or you think we might be able to help you, we will talk to anyone at any time. It does not matter if you are going to have a sale anytime soon or not. We want to help you. Please reach out. Start building a strategy, putting it in place now. And don't try to time the markets. That's the most important thing we can learn from this situation. Everything was cruising, and then boom, something happens and stops all the progress. So let us help you. If there's anything we can do, we'd love to. Have a great week, and we wish you all the best.